For today's Business Matters, the Chinese regime has released all the staff it detained from U.S. firm Mintz in a move to smooth relations after a business summit that seeks to attract foreign investment. The regime detained 5 staff members of Mintz, all Chinese nationals, 2 years ago, right before that year's business summit. The move shocked foreign companies. Foreign investment in China fell more than 27% in 2024 compared to a year earlier. It's the biggest drop since the 2008 financial crisis. The Mintz staff were detained after a raid at the company's China offices. It marked the beginning of a crackdown on consulting and due diligence firms with offices in the country. Now, according to a source in an earlier Reuters report, Mintz was examining the possible use of forced labor supply chains linked to China's Xinjiang region at the time the regime arrested its staff. Meanwhile, a team from Alaska has crossed the Pacific to discuss energy cooperation. South Korea is hosting Alaska's governor, state representatives, and energy officials, including representatives of the Glenfarne Group, a partner in the Alaska Liquefied Natural Gas Project, a $44 billion pipeline that will transport gas from Alaska's remote north. South Korea is the world's 3rd largest buyer of LNG. Governor Mike Dunleavy met with his counterpart from South Korea's most populous province, who said he hoped the U.S. and South Korea could pursue mutually beneficial cooperation. Dunleavy said President Trump also hopes the talks on the LNG project would benefit all parties. The president of messaging app Signal is defending its security. This comes after top Trump administration officials mistakenly included a journalist in an encrypted chat room. The chat was used to discuss looming U.S. military action against Yemen's Houthis. Democratic lawmakers called this a breach of national security. On X, President Meredith Whittaker did not directly address the blunder. Instead, she described the app as the gold standard of private communications and outlined Signal's advantages over competitor WhatsApp owned by Meta. On the road, rain or shine for Aurora Innovation's self-driving trucks. The Uber-backed company announced that it will allow its self-driving trucks to operate without a driver in inclement weather. Aurora plans to expand the operational design domain to include harsh weather. ODD specifies the conditions and areas in which self-driving vehicles can operate, taking into account geography, weather, and other factors. This is ahead of a planned launch of commercial truck service this year. The autonomous trucks are expected to start operating on public roads in Texas, New Mexico, and Arizona. Shoppers appear to be skipping the spice aisle. Spice maker McCormick has reported missing its first quarter profit estimates. The Cholula hot sauce maker has ramped up price cuts on its spices, sauces, and seasonings. This is on top of the increasing investment on promotions. Despite the efforts, the company has been unable to boost demand. Quarterly volume in McCormick's consumer segment is a major revenue contributor, and it rose only 2.6% from a year ago. But prices fell following an increase in the previous year. Waymo is hitting the road for Washington, D.C. Alphabet's self-driving unit has mapped out a launch for next year. Waymo said it will work closely with policymakers on legal frameworks since D.C. doesn't allow fully autonomous operations right now. The company has been under scrutiny over safety concerns. The NTSA opened an investigation last spring after receiving nearly 2 dozens of reports Waymo robotaxis potentially breaking traffic laws and 17 reported accidents. Based on Waymo's collision data, the company says its vehicles have been in fewer crashes that caused injury than the average human driver. Affirm and JP Chase have reached an agreement on installment loans. The fintech lender announced in a press release that its buy now, pay later loan services will be an option soon for merchants on JP Morgan's network. That means U.S. merchants who use JP Morgan to handle payments will be able to add Affirm as an option to their checkout pages. Shoppers will have loan options from 30 days to 60 months. And this deal comes on the heels of a similar announcement from rival Klarna, who will also be an option for JP Morgan's merchants. 23andMe has filed for bankruptcy, marking the downfall of the up-and-coming biotech company. The fallout from a data breach and weak demand for its ancestry testing kits is renewing questions about how that information was used. NTD's Andrew Thomas has more on the broader privacy concerns.
In 2021, 23andMe went public at a $3.5 billion valuation, but a 5-month-long data breach 2 years later exposed the personal data of nearly 7 million customers, a huge blow to the company's reputation.
If you think about the way that 23andMe essentially made its money, it was through the acquisition or the collection of really sensitive information.
But just because 23andMe has gone bankrupt doesn't mean your personal information has evaporated in cyberspace. Someone else will likely acquire it.
So essentially what that means is the acquiring company has to uphold the same standards to the information that 23andMe has already put in place, but users should be cognizant that there likely might be a transfer of that information and understand who that third-party acquirer is meant to be.
In the digital age, data has become a necessary commodity. Users can't take advantage of most products and services unless they provide their personal information.
Data really is the new oil. So sometimes, you can't interact with a website or you can't interact with a product unless you give over the information that they require.
Host of What the Hack, Adam Levin, says DNA is the most sensitive of all data.
So because of the very sensitive nature of this information, unless it is under your absolute control or you're worried about the fact that anyone else who may have it is in a position to misuse it, then where you can delete it, you should absolutely delete it.
Late last year, 23andMe laid off 200 employees and stopped development for all therapies. 23andMe secured a financing commitment of about $35 million on Sunday and will continue to operate during the sale process. The company listed assets and estimated liabilities between $100 million and $500 million. Andrew Thomas, NTD News.
Efforts to hire more air traffic controllers are gaining momentum after a series of deadly aircraft incidents raised safety concerns. FAA officials say 10,000 applicants applied for high-paying positions during a short hiring window. The acting administrator says they're working to get the best candidates trained and in place quickly. The push follows a commitment by the Trump administration to address controller shortages and modernize the FAA. Nearly 200 candidates have already advanced in the hiring process. A United Airlines flight headed from Los Angeles, California to China had to turn around and return back to the U.S. because one of the pilots forgot their passport. United says the incident happened Saturday with 257 passengers and 13 crew members flying over the Pacific Ocean bound for Shanghai. They were 2 hours into the flight when the plane turned around and went to San Francisco. United says it got a new crew to take over the flight, which took off again a few hours later. The flight landed in Shanghai about 6 hours behind schedule. Supermarket chain Kroger is countersuing its rival Albertsons after the collapse of a $25 billion merger deal between the two companies. Kroger claims that Albertsons engaged in a secret campaign to derail the merger. NTD Shaw Marshall has more.
U.S. grocery chain Kroger countersued rival Albertsons on Tuesday, escalating a legal fight between the two companies following the demise of their proposed $25 billion merger. Albertsons terminated its bid to merge with Kroger in December after courts blocked the deal and sued Kroger, alleging a breach of contract that led to the deal's collapse. The formal termination ended a 2-year effort by the grocery chains to combine. In court documents, Kroger says that while it worked diligently to seek regulatory approval and close the merger, Albertsons engaged in a, quote, secret and misguided campaign together with C&S Wholesale Grocers, the divestiture buyer, to pursue its own regulatory strategy, which ultimately undermined Kroger's efforts. As a result, Kroger says Albertsons is not entitled to a $600 million termination fee or the other damages it seeks. Albertsons, on the other hand, says it was, quote, committed to the success of the combination from the outset, and it was Kroger that didn't hold up to its end of the bargain. Albertsons also says that it looks forward to presenting its case in court. Sean Marshall, NTD News.
Postmaster General Louis DeJoy resigned yesterday. DeJoy served as the 75th Postmaster General since 2020. The USPS says under his leadership, it developed and started implementing a 10-year plan to modernize the service and gain financial sustainability. But DeJoy's tenure was also fraught with delivery delays and financial losses. President Donald Trump has floated plans to give the Secretary of Commerce oversight over the independent government agency. Currently, a board of directors oversees the Postal Service. Deputy Postmaster General Doug Tulino will lead the agency until the board names a permanent successor. Massachusetts regulators are investigating financial services company Robinhood over its launch of a prediction markets hub. It allows people to bet on everything from basketball games in the NCAA tournaments to the chances the Federal Reserve might cut interest rates. Users can buy and trade financial contracts tied to the outcome of a given event, essentially betting on the outcome. The Secretary of the Commonwealth of Massachusetts sent a subpoena to Robinhood on March 20th. It wants Robinhood to provide information by April 3rd about state residents who request to bet on college sports. State officials also want internal company communications about the hub's launch. Shell has pledged to return more cash to shareholders on the back of higher natural gas sales, mainly via buybacks. The company is also trimming its investments through 2028 and raising the prospect of selling or closing some of its chemical assets. Here's more.
Shell increased its shareholder distribution policy on Tuesday to 40 to 50% of cash flow from operations, with a focus on share buybacks. It also lowered its annual investment budget to a $20 to $22 billion range through to 2028. The world's biggest liquefied natural gas trader said it wants to grow LNG sales by 4 to 5% each year in the next 5 years, while keeping its oil output stable at 1.4 million barrels per day. Shell estimates that global demand for liquefied natural gas to rise by around 60% by 2040. That's largely driven by economic growth in Asia, the impact of artificial intelligence, and efforts to cut emissions in heavy industries and transportation. The oil major has a $3.5 billion buyback for the current quarter, making this the 13th consecutive quarter of at least $3 billion of share repurchases. Shell spent around $8 billion by the end of last year on low-carbon solutions, set for 2023 to 2025. It said by the end of the decade it would have up to 10% of its capital employed, which measures the sum of total equity and debt in low-carbon platforms. A Shell spokesperson declined to give an investment figure for its low-carbon businesses beyond 2025.
And a new survey shows Americans' faith in the economy continues to drop. The Conference Board said in its latest survey that consumer confidence this month slid to a reading of 92.9, and that's the lowest since January 2021. The survey showed Americans are expecting higher inflation this year, and more are also predicting the economy will slip into a recession. The combination of weakening growth and accelerating inflation resembles stagflation. Federal Reserve officials also see the U.S. economy trending in that direction. Charlie Brown, Snoopy, and the whole Peanuts gang are coming to Starbucks. It's part of a global partnership between the coffee giant and the Peanuts brand. It's featuring a new Snoopy persona, Joe Kind Snoopy, and celebrates kindness, coffee, and community. The Peanuts-inspired limited edition merch includes a cold cup, ceramic mug, and stainless steel tumbler. Prices range from $17.95 to $29.95. They'll be available at participating Starbucks coffee shops across the U.S. while supplies last. South Korea's Hyundai Steel says it will invest billions along with Hyundai Motor Group to build a steel plant in Louisiana. Here's more.
South Korea's Hyundai Steel will invest $5.8 billion along with Hyundai Motor Group to build a steel plant in the U.S. state of Louisiana. The company says it will have an annual capacity of 2.7 million tons. Hyundai Steel shares initially jumped more than 5% on the news, but reversed early gains to end 7% lower as U.S. President Donald Trump praised the company's plan. Hyundai Steel's proposed new U.S. steel plant is part of Hyundai Motor Group's plan to invest $21 billion in the US. The move is seen as an effort by Hyundai to shield itself from US tariffs on steel and cars, but it's not clear whether this will help secure exemptions for Hyundai and South Korea. Trump has threatened to impose reciprocal tariffs on numerous countries on April the 2nd, and potentially targeting South Korea, that has a large trade surplus with the US. Shares in Hyundai Motor and affiliate Kia, which are expected to source steel from the proposed factory, rallied. Hyundai Motor shares ended up 3.3% and Kia closed up 2.1%. Analysts, though, have expressed concerns about how Hyundai Steel, which has billions of dollars of debt, would fund the construction of the factory.
And joining us now to talk about some easy-to-fix common mistakes that credit card holders are making is Ted Rossman, Senior Industry Analyst at Bankrate. Ted, good to see you. Thanks for coming on. So, according to a new Bankrate survey, it shows that among credit card holders carrying a balance month to month, about 72% are still making an effort to earn credit card rewards. Is this something to avoid? Talk to us.
The reason this is such a big mistake is because credit card interest rates far outweigh the value of the rewards that you're earning. The average credit card charge is about 20%, and a typical rewards payout is something like 2% if we were to benchmark an average. Sometimes it's a little higher depending on the category, but if you're getting a blended average of about 2% back in terms of cash back or airline miles, that's pretty good. That's a lot less than the 20% annual percentage rate that a lot of people are paying. So that's why I say if you have credit card debt, no shame, a lot of people do. In fact, it's almost half of cardholders. Knock out that debt first before chasing rewards.
And what would you say to someone who believes their rewards earnings are offsetting their interest payments?
The math just doesn't work out. I realize that 20% is annualized and the 2% or so in rewards is something you get right away, but you're still upside down if you're carrying a balance for any length of time. It really makes sense to seek out the lowest interest rate possible if you have credit card debt. You can get a 0% balance transfer card for up to 24 months. A lot of the best balance transfer cards don't offer rewards, but in this case, your reward is the 0% promotional rate, and it's the opportunity to get out of debt quicker at a greatly reduced cost. So if you have credit card debt, look into things like the US Bank Shield Visa, the Citi Simplicity, the Wells Fargo Reflect. Those are 3 of the longest balance transfer terms on the market.
But are there any cases where carrying a balance and earning rewards might make sense?
Carrying a balance is really never a good thing as far as the interest charges you're racking up. It's not as good for your credit score either, but really interest is the big consideration. This is why people say credit cards are like power tools. They could be really useful or dangerous depending on how you use them. And it is roughly half and half. 56% of cardholders pay in full every month. And for them, they should go for rewards. That's free money. I mean, as long as you're avoiding interest, it's all gravy. But for those 44% who are carrying debt, it's really important to prioritize your payoff efforts. Credit card rates are so much higher than most other forms of debt. This is the priciest debt for most U.S. households.
And Ted, what would you say is a good rule of thumb for deciding whether a purchase is worth putting on a credit card for rewards?
Ideally, you would use credit like debit, meaning that you pay in full, you don't owe interest. Credit cards have better rewards programs than debit. They have more buyer protections. There's a lot to like if you're paying in full. For someone with credit card debt, we talked about how 0% balance transfer cards can be really beneficial. Nonprofit credit counseling is another good option. Reputable groups like Money Management International can help you out. But if you have debt, consider sticking to cash or debit as you pay it off. Don't dig the hole any deeper. That's really one of the best tips for those balance transfer cards is don't add new purchases. Just divide what you owe by the number of months in your 0% term and try to stick to that.
Okay, other than this mistake, are there any other common mistakes that you'd like to talk to us about?
Definitely chasing rewards when in debt is a big mistake. Carrying a balance in general, I don't know if it's always a mistake. Sometimes it's kind of a feature. I mean, I'd rather everybody pay it off right away. sometimes I get it. You need to carry a balance and finance some essentials, but sometimes people carry a balance because they think it's going to help their credit score. That's a myth that's out there. You definitely want to pay in full and on time every month if you can. If you do hit a bit of a rough patch with your finances and you need to carry debt for a time, that's when you should seek help, like a balance transfer card or like nonprofit credit counseling, or also consider other ways to pay it off. Maybe take on a side hustle or cut your expenses. It's hard to build wealth when you're paying 20% interest for any length of time.
Can you elaborate on that? Do you have any more advice for getting a credit card balance back down to zero?
I love this balance transfer approach. If we go a little bit deeper on that, the average credit card balance is around $6,000. So that sounds like a lot, but if you were to divide that by 24 months, which you can get interest free on a card like the US Bank Shield Visa, now all of a sudden you're talking a few $100s a month in payments. And you really just try to stick to that level payment plan. That's why this can be so beneficial. We contrast that with the minimum payment math, where if you owe $6,000 and you're paying minimum payments at 20% interest, you could be in debt for 18 years and you could pay $9,000 just in interest. And that's because minimum payments are really a trap. The typical formula is 1% of the balance plus interest. So you can see how that keeps you in debt for a really long time.
Well, all right, Ted, as always, great speaking with you. Thank you very much.
No problem. Thank you.
Next, the Nasdaq ended higher today with Apple rising and Nvidia dipping as investors assess consumer sentiment data and bet on a more flexible trade policy stance from the Trump administration next week. So US President Trump said on Monday that automobile tariffs were coming soon, while suggesting that not all proposed tariffs will be enforced in an April 2nd announcement, on which Wall Street is very much focused on. Other than that, ratings agency Moody's said on Tuesday that the United States' fiscal strength is on track for a continued multi-year decline as budget deficits widen and debt becomes less affordable. And with that, everything on today's Business Matters.